I actually think this is the first time in 10 years where we're bellying up to the bar and we're buying Microsoft and we're buying Nvidia, and we can legitimately call them value stocks. So, I would urge investors to look through the war and position their portfolio for what will probably be a decent year of economic growth after this is behind us.
So talk to us just about maybe some of those tech names, the Nvidias of the world, the Microsofts of the world. That AI trade is kind of turned on some of these technology names. It's not so much spend, and we'll bid your stock prices up. Now people are starting to say, does AI pose a risk to some of these other technology names? And Nvidia, but particularly Microsoft and some of the software stocks, were really hit on that. How do you think about that?
Sure. So I think the essential question, Paul, is to determine whether you think AI will be more disruptive than the consensus thinks or less disruptive. And if you think it's going to be more disruptive, you buy Nvidia because the money is going to keep coming that way, and you sell these software stocks. Microsoft is kind of a hybrid, but we're much more on Microsoft on the side of AI disruption because they're so integrated with so many firms that they will find a way to survive. Whereas other software companies, even though they're cheap, and as a value guy, you think I'd be interested, I think there is going to be more disruption. The reason I say that, Paul, is because the folks we talk to, the more they know about coding and software, the more scared they are. So that's the difference here.
A Salesforce Inc., for example, down 27% this year. One could argue it is so embedded with its enterprise customers that it's not immune, but they're less at risk than, say, maybe a one-off software application kind of player. Yet the market's punishing them.
I think they certainly are less at risk, and you touch on exactly the right thing. How embedded are they? But that doesn't mean they're good investments still, because one, they started at a high multiple, and second, what is going to happen to their growth rate going forward, and what will investors feel about the investment in the sense of, will they have as bright a future as we thought they would a year ago? I'm not quite sure they will.
How do you as an equity guy interpret, I should say folks across the nation, Chris Grisanti with this MAI investment, we're going to do a lot of equity today. Lori Calfacino will darken the door here in a bit. How do you interpret ginormous bond offerings? Is that a good thing for a stock?
It's not a great thing for a stock, Tom, but if there's ever any companies in the history of the world, frankly, that could afford to lever their balance sheet, it's Microsoft, it's Amazon, it's Google. They're AA or better companies, Microsoft's AAA, and they can use the leverage, and they clearly see an opportunity. So that, on my list of worries, which is extensive, that's not near the top of the list.
What's your number one worry? Besides, Duke may not make it.
Right. Well, that would be a dream for me, not a worry. But my number one worry really is that I'm overemphasizing the value of AI. I don't think I am, but if it turns out to be something where they're going to dial back the spending, that's going to change my thesis about the way forward.
Chris, as a value investor, what screens well for you guys these days? Is it a sector? Is it a factor? What's looking good for you?
It's funny, as we mentioned, Paul. Some of these Mag 7, now they're not a monolith, but some of these Mag 7, whether it's Amazon, it's Microsoft, it's Nvidia, they're screening attractive for the first time in 10 years, and it's because people are saying, "Well, this AI thing has gone on for too long, and we're getting off this horse," and I think that's a mistake.
Earnings growth has been pretty darn solid here. We've got a Fed that's presumably going to be cutting rates here. Does that set up for you, despite all the geopolitical noise out there, which is real because it goes to energy and inflation? Is the fact story of earnings growth, is that enough to support this market?
I think it is, Paul, once the war is behind us. It's not only the earnings growth, it's the Fed. And I disagree with the consensus. I think the Fed, if this oil price stays high, is more likely to cut rather than less likely, because this is the kind of classic definition of a shock that the Fed will cut for. And finally, the one big beautiful bill, it's 2026 when all this stimulus kicks in. So you got some nice tailwinds once the war is behind us.
But some folks will say the one big beautiful bill benefits may be offset now by the higher oil prices and inflation.
Yeah, maybe. But again, let's imagine a world 2 to 3 months from now. Oil's back down to 80,
okay.
And it's not as good as it was. But this is behind us, and what we're looking at is strong earnings and lower rates.
Speaking of earnings, what do we look like here? It's March 31 coming up. Is it going to get above 40 degrees? Can you work on that? It's March, whatever. The Sunday was brutal.
Yeah,
it was almost cold.
Yeah.
You look at this, Chris Grisanti, we're going to get out to April 15th, April 16th. Is it once again, oops, we got growth of earnings, growth of revenues wrong?
I think so, Tom. I mean, look, we had a higher estimate than consensus for 2025, and we were too low. And so I think we're going to exceed on the upside again. And this is a recovery with a long tail. It's a blessing for investors.